I discovered that the world was going in the direction of risk-return impact. And it became obvious to me that if you wanted your whole economy to do that, then you had to have impact accounting like profit accounting.
We developed a model called social impact bond, which is essentially a partnership between a social investor putting capital into a social provider to deliver an intervention, but then government standing behind that provider who was repaying that investment on an outcomes basis, so only if certain social outcomes are achieved.
You said to me, how do you go about the process of picking bonds? First and foremost, still has to be the financial criteria, because ultimately, if you get that wrong, if in extremis a company goes bust, you're neither going to deliver the financial return, nor are you going to deliver the impact.
We're all aware that the climate is affected by gas emissions. But if you say a company has 1 million tons of gas emissions a year, you don't really understand the significance of it.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. You were doing straight up VC and PE, trying to hit sixes, trying to keep your eye on absolute returns, weren't you?
We set off at the outset saying, we're not going to invest in gambling. We're not going to invest in alcohol. We're not going to invest in weapon manufacturing companies. We're going to do everything in an honorable, transparent way. So there were values underlying it. But if you ask me, how did that impact side connect with getting into venture capital? I had a very clear sense of mission that by going into venture capital, I would be creating much needed jobs in the UK and in the other countries. We expanded to 10 countries or so while I was leading the firm, that we were creating jobs for people that otherwise would find it very difficult to achieve financial success in life, at scale. But I discovered while I was at Apex that while indeed we were helping people from humble backgrounds make a lot of money, if you looked at the total gaps in society, we were increasing the gaps because we were enabling some people to make huge fortunes and others were being left behind because they didn't have the education and the training or didn't happen to be in the two fields where you could make fortunes during my lifetime, which were technology and the finance that funded tech entrepreneurship. And so I said to my partners at the age of 53, I'm going to leave the firm at the age of 60 to focus on two issues, social issues and the Israeli-Palestinian conflict. And I want to give myself 20 years to do something significant in these areas. And after me, everyone will leave at the age of 60. The firm will be run as a partnership. I will let go of my shares at a very low price, and everybody will do the same after me. So my motivation was always social in a way. I wanted to do good and to do well. And of course, when I began to connect in a professional way with how do you achieve social good, that experience as a venture capitalist was hugely relevant because serendipity and luck affects all of our lives. I'm sure it affected your life and the lives of many people around you. In my case, while I was leading Apex, when I was 55 years old in 2000, I got a phone call from the British Treasury. It was the Blair-Brown government, saying, we've been very concerned about dealing with poverty in a better way. However much money governments throw at poverty, They don't seem to be able to make a dent in it. Would you have a look with a more entrepreneurial eye at how we can do a better job of dealing with poverty? And in 2000, I led a task force called the Social Investment Task Force. And what did I discover, Scott? I discovered that while in venture capital, we'd invented a completely new way of funding entrepreneurs. Never before had you had 10-year funds that don't pay anything out potentially for 10 years, where you can lose the whole of your money and make a multiple if you're lucky, backing entrepreneurs who don't have much business experience. We've invented a new way of funding high-risk, long-term ventures for people who wanted to make money. And it occurred to me what we hadn't done was to bring investment alongside government spending and philanthropic giving to tackle social issues. And so if you read the report of the Social Investment Task Force in 2000, you will read that I said we have to develop financial tools, innovative tools that are appropriate for those who want to improve society. And that challenge is really the challenge of the last 24 years for me, because I set off to try and bring that financial innovation. And by 2010, we'd invented the social impact bond, which was the first time you had a security where the return depended, in that particular case, on reducing the number of prisoners going back to jail after their release. Never before had investors put up millions of pounds, £5 million in this case, in the expectation that that funding would lead to a reduction in the number of prisoners going back to jail, young prisoners, and that their return would depend on the number that got out into the world and into jobs and led normal lives instead of going back to prison. Now that's led today, another 14 years later, to $1 trillion market in sustainability-linked bonds and loans, where a company borrows money from the bond market or from a bank, but pays less interest if it achieves a social or an environmental objective that has been set. That financial innovation was the definition of a new financial approach to fund those who want to improve the world. And the road to impact investment from there went on to say, well, if you look at it in financial terms, what you're doing is, in a social impact bond, is you're balancing risk, return, and impact. In investment terms, you'd say you're optimizing them. You're achieving the best balance between risk, return, and impact. Well, if you can do that for a security, why can't you do it for a whole economy? And when I was asked by the British government again in 2013 to lead the G8 Social Impact Task Force, the language had changed from social investment to social impact, I discovered that the world was going in the direction of risk, return, impact. At that time, ESG investment was 13 trillion, while today it's over 40 trillion. And it became obvious to me that if you wanted your whole economy to do that, then you had to have impact accounting like profit accounting. You had to be able to measure the performance of a company in delivering impacts as well as profits. And that led me to this last leg of the past 5 years, which I think has just had the breakthrough we aspired for, of creating impact accounting, of cracking the code of measuring and valuing impacts in a similar way to profit.
And this is coming out of your work of one of your pillars of the GSG impact, which is impact, transparency, and integrity. And this project that you're referring to is the International Foundation for Valuing Impacts, which I'll refer to as IFVI. And you know, Sir Ronald, we all need more acronyms in the financial services business. Can you give a high-level overview of what this initiative is about and describe exactly what's the problem that IFVI is trying to solve?
We're all aware of climate change. We're all aware that the climate is affected by gas emissions. But if you say a company has 1 million tons of gas emissions a year, you don't really understand the significance of it, right? If on the other hand you say, look, let's look at 3 fossil fuel companies. Exxon delivers $39 billion a year of environmental damage. Shell delivers 23, and BP delivers 13. Now, all of a sudden, you have an image in your head because you understand the importance of money. So whereas 1 million tons doesn't give you a frame of reference for the importance, when you're talking billions of dollars, you immediately understand it. So the problem IFVI tackled was, how do we value the impacts a company creates, the environmental impacts and the social impacts? Now, if I ask you that question today, Scott, probably your mind would go blank. You'd say, well, I don't know how the hell you go around measuring water and, water usage, water pollution, soil erosion, waste. Well, we worked out how. We realized you needed a big data set. You needed, for environmental, 100,000 or more values for 530 impacts across the world in 268 locations at least, because a liter of water in the Sahara or a cubic meter of water in the Sahara doesn't have the same value as a cubic meter in Manhattan. And if you had all of this information, then if you connected it to the emissions of a company, you'd have money impacts, environmental impacts, like the ones I described. And that's what we launched on September 25th during Climate Week in New York. 100,000 value factors. Now, if you had them on your screen, and by the way, it's open source, so everybody listening to your podcast, Scott, can download the database on their PC, use it free of charge. But if you're an investor, you'd probably go to your Bloomberg terminal or your S&P data feed or your MSCI data feed or your FactSet terminal. And on that terminal, you'd press a button and it would match all the facilities of a company, all its factories, warehouses, and all the disclosed emissions, water usage, water pollution, waste, acres of land which have been deforested, and connect them with these valuations according to their geography. And so you'd look at a company differently. It had sales of so much, it had costs of so much, and it had impacts of so much. Now, some impacts, like environmental ones we've been discussing, will be negative. Some, like the value of their product for consumers, will be positive. The employment they create will be positive. And so you'll begin to give investors the tools to say, you know what, if I have to invest in a fossil fuel company, I'd rather invest in the one that is moving in the direction of clean energy and creating the least damage, because someday, maybe after President Trump leaves office, we're going to get back to the fact that climate change continues to worsen. We're going to have to tax companies to prevent them from continuing to pollute the environment, and we will reward companies through tax credits for the good impacts that they create.
So the idea of standardizing sustainability data and impact data and giving it a monetary value, of course, makes sense. It'll make it easier to compare companies, be easier to evaluate impact between companies. But when I think about how ESG metrics or impact metrics are currently measured or reported, and they're all so nuanced, what does this look like in practice? I mean, how does this not end up being another footnote buried somewhere in an annual report?
What's going to shift the behavior of companies, because companies are the ones that create impacts, not governments, is the behavior of investors. When investors have access to information that enables them to measure in a reliable way the impacts companies create alongside the profits, you're going to change the values of companies, because investors will shift to the companies that are doing the best job of delivering both profit and impact. Because of what we've just said about regulation and taxation in the future, but also because a lot of consumers don't want to buy the products of companies creating harm, and a lot of talent doesn't want to work for companies that create harm. So the attempt now to push back on anything that doesn't have to do with profit will lead to the pendulum swinging again in the direction of solving the big challenges we face. You can't solve them by ignoring them.
Well, the devil's in the detail. You mentioned all these data. So, for example, like a carbon footprint is currently measured by tons of carbon emissions. So when you convert this to a monetary value, is this framework referencing the price of carbon? Or is it something like current carbon price versus current tons of CO2 in a given time frame?
No, the price of carbon we've arrived at on the basis of the best scientific knowledge available is $236 a ton of carbon emissions. And you have the same for water usage, water pollution, soil erosion, and so on.
For a multinational company, does it take into account regional differences?
Yes, because they're GPS locations that give different valuations in different parts of the world.
So I'm picking on carbon because it's something that already has a market price that we can easily discuss. I'm trying to keep things simple, maybe so simple that even someone like me can understand this. How does the process work for more obscure metrics where there isn't a quick reference or a common value, maybe something like, I don't know, employee training or community impact? How do you approach monetizing these more intangible types of metrics?
So health and safety at work, you can look at the economic benefit of people not being injured, right? There's the cost to the health system. There's also the cost economically to their being out of work, etc. So you're measuring the economic dimension rather than the total human dimension of the problem. The same would apply for diversity, If somebody is excluded from work for ethnic reasons or gender reasons or whatever, it's a cost to their community. So if you look at the percentage of the population of a certain ethnic or gender background that is employed versus the community demographics, you can apply a salary level to the difference between the two. And then you get a dollar figure that says Amazon has a diversity debit of $6.5 billion a year, and Apple has one of $2.5 billion a year. But if you take it as a percentage of wages, Amazon is at 16.5% and Apple's at 25% diversity deficit. So you can measure the economic cost or benefit, Even in terms of health in a food product, if you're consuming sugar, there's scientific evidence of the cost to health of consuming sugar. If you're eating grain, there's a health benefit to eating grain. These figures exist. So in a way, what we have done at a time when there's increasing transparency on quantity metrics is to bring the valuation part of it so that you can translate it into money and compare it with profits and across different impacts, social ones, environmental ones, and so on.
But in order to make companies comparable and their impact results comparable, everyone's got to be using the same values.
Correct.
So how do you envision this? Is this something that there's going to be one central body globally? And so how do you ensure accuracy and that everyone agrees these are accurate?
So you do it in the same way that we do for profit, because when you calculate the profit of a company, you have standard accounting policies for every company, irrespective of size or sector. You can depreciate your equipment over a certain number of years. For example, every company has to follow the same rule. It's called generally accepted accounting principles. We're going to have generally accepted impact principles. That's what we're building. And so 2 organizations in the world are responsible today for the standardization of financial accounting. One is the SEC in the United States. The other one is IFRS in the rest of the world. Now, the SEC was engaged in environmental measurement, and now the Trump administration is rowing back from that. But IFRS is progressing in 192 countries to standardize quantity metrics, tons of carbon, cubic meters of water, and how you measure them and so on. And we are bringing the valuation to whoever wants the valuation. So over time, you would expect IFRS to incorporate our value factors within their rules, within their principles. So every company would observe certain financial accounting principles and certain impact accounting principles.
So who do you see as the primary users of this methodology? Are you primarily targeting companies for their internal decision-making or investors making allocation decisions?
It's a bit like technology at the beginning, when some people thought this is going to only be applicable to the computer industry. The microchip is going to transform the computer industry only, right? Today, I think you're going to see uptake of this impact information, first by investors. $40 trillion of ESG money wants to achieve risk, return, and impact. Without measuring the impact today, they can't do it. You're giving investors the tools to make better decisions. At the same time, you're giving companies the ability to improve their impact performance because you're giving them a measurement tool which helps them to satisfy the expectations of investors. If investors are going to companies that have reduced emissions relative to their competitors, companies will invest in reducing their emissions. They're going to need to make a calculation about how much do I invest, what benefit does it lead to in terms of emissions, and what's the effect going to be on my share price. So companies will pick it up. Apps for consumers will pick it up. You have apps now where you point your phone at a barcode on the supermarket shelf, and it tells you whether the product is good or bad for your skin or your health or your nutrition. Those apps will have, is the company delivering this product polluting the atmosphere more than its competitors or less? If you discover that company is polluting a lot more and the product is similar to another company is producing with much less pollution, if it matters to you as a consumer, you go to that product. So consumers will pick it up as well. Governments, by the way, will also pick it up because governments are trying to solve social issues, which is where our conversation started, right, with the Social Investment Task Force in 2000. But they don't have today a measure of the social impacts that companies create. They know how to incentivize the creation of profit through taxation, tax credits, investment, and all the rest of it. They don't know how to do that for social impacts. Well, now they will know. They will know what effect the company is having on the population it serves. And they will be able to incentivize behavior that helps to achieve a better society. For example, if you look at the pharmaceutical companies today, some of them are borrowing in the sustainability-linked market, which is $1 trillion, to which I referred earlier. The rate of interest they pay on their borrowing falls if their pharmaceutical products reach more vulnerable populations, poorer populations, within developed countries and outside. So all of a sudden, governments have visibility on what they're trying to incentivize, and they can begin to give out tax credits to the companies that are doing a good job in the social area. But if you say to me today, if I had a magic wand and I wanted to put a priority on one of these groups, which would it be? It would be investors. Because investors are the lifeblood of capitalism. Capital is the lifeblood of capitalism. And if you begin to change the behavior of investors, then you change the behavior of companies and the behavior of our whole economies. And instead of creating problems, our economies begin to deliver solutions to our environmental challenges, but also to our social challenges.
So what kind of resources would an organization need to effectively implement this type of impact accounting to make this methodology accurate and effective?
The answer is not a lot more than they have now, because they're already being asked by myriad different agencies to publish their carbon emissions in different forms, at different times, measured differently. It's a disaster for companies. There's a huge bureaucratic burden that is placed on them. When you bring them valuations in addition to that, you make it a lot easier for them to say, look, we're going to have one metric, one valuation. You're going to have a dollar value or a euro value or a yen value or whatever as an investor or as a government to look at. It also makes it much easier when the regulations come in, as they've been coming in Europe, to say what's material, what's important, what's not important in terms of the impact created. Now, you can say what's important is whatever affects your revenues or your profits, more than 5%. You don't have to go through 100 different criteria explaining the importance of it and why it shouldn't be taken into account and should be taken into account. So in terms of reporting, disclosure, and compliance, it will facilitate things.
And you think that there'll be the support from independent bodies to audit this as there is today for GAAP and all that?
I think in the United States now for the next 4 years, we're going to see pushback on this type of thinking. But an American company working in Europe is still going to have to abide by European regulations, likewise in Asia. And the world isn't going to stand still with respect to this, because there are investors everywhere in the world who believe that climate change will just continue to worsen. And we have to be prudent.
How likely do you think supporting regulation will be introduced to make this type of reporting mandatory? And would something like that be essential to make this truly transformative?
I think it's going to be driven by markets more than governments. Let me explain. Rather than government policy, it's going to happen, in my view, in this way. The data we've been talking about valuation metrics of quantity on different impacts, it's going to become much more accurate and much more widely available. Investors are going to use it, and it's going to affect the valuation of companies. Regulators have to maintain, as you were saying earlier, a marketplace where everybody has access to the same information at the same time. You can't disadvantage people because others have better access to information. So when the information is out on the Bloomberg screen or whatever, the regulators are going to have to start looking at it and standardizing. And then eventually government can have policies and so on. But the regulators will be the ones who will make it mandatory to abide by certain principles in calculating your impacts and valuing them.
Explain social finance's theory of change for using finance to produce transformative social impact, and make the case for how applying capital can solve social problems. And at the same time, I'd like to know what it cannot do.
Well, I think almost to start with the last bit, which is that I think, in our experience, it's never just about the finance. It's never just that there was a program that, in the kind of work that we do in the sort of, again, acute end of need, it's never just that there's a lack of repayable investment, but finance can, unlock a different way of doing things. And I think there's a few things that we've noticed when you bring finance to the table. I think it does, we all talk in this sector about the importance of partnerships, and it is, it is really fundamental to our way of working. But I think often in the kind of partnerships that exist in the sector, people can get around the table and all say the right things, but are they 100% clear on exactly what they're all partnering to achieve? And when you bring finance to the table, it is a real forcing mechanism for creating partnerships where everyone is 100% clear on exactly what outcome we're all looking to achieve. And we're actually going to measure that. And if it's not going well, we're going to do something about it. And so that's the second point, really, which is that it does create a real focus on outcomes. It forces you to specify exactly what outcomes you want to achieve in advance. It forces you to measure those outcomes. And then, it forces a really rapid assessment of, how do we do better during the program delivery, which is something that actually, often we talk about the policy implementation gap in public policy. And, this is a discipline mechanism to make sure you're really going to follow through implementation, because there are investors sitting behind that program who are dependent on those outcomes being achieved to get their investment back and to get a return. And so they're going to make sure that there is a real focus and that we make some changes live. I think it certainly brings, a different set of skills around the table, and, that sort of focus on data, on analysis, on driving through implementation, I think is really valuable. And then the final piece is that I do think bringing finance to the table can drive a focus on the sustainability of social programs. And this is in particular contrast to, some traditional forms of grant making, where, the grant can have real impact, but ultimately when it ends, the program tends to come to an end. Whereas if from the beginning, the system that you're working with knows that it will ultimately have to pay the money back, then the business case has to be there up front for, okay, we're not sure this is going to work, so it's fantastic that someone else is willing to put their capital at risk to test it out. But if it does work, then we will pay that money back. And actually, if that business case works, then why don't we just continue to fund it in the future again as well? So even once the initial project finance comes to an end, the system has a really clear case for why it should continue to fund that program.
What type of challenges are well suited to be tackled by a social impact bond, and what kind of challenges are not?
It's a great question, and it also speaks to our evolution of the way we've evolved in the social impact bond and also evolved around and beyond it. Now, I think the key areas that it really works is where you have a very kind of well-defined group of people, usually with some quite acute need. So we're talking, as I say, about people maybe with criminal justice experience or drug and alcohol issues who are rough sleeping, for example. and where you can define a very clear and measurable outcome that we can all agree is both really important for the people concerned and the communities that they live in, operate in, but also for the system in terms of usually, we've got parts of government that are having to, address some of the response to these issues. So if you take rapid sleeping, for example, everyone can agree that, it's a really important issue to address. It's a very well-defined group of people. We can put in place a very specific program and be fairly sure that, because it's a well-defined group of people with an intense need, that if those people get an outcome like finding a house at the end of it, it's the result of the program that we put in place, not just kind of other factors that happen at the same time. And the outcome in terms of those people being housed, is great, hopefully for the individuals, but also the government then, doesn't have to provide services that maybe rough sleepers need. And that could potentially even be cost effective for government at the same time. So that's a kind of really nice, example of where the social impact model, you can put a program around that and it can work well. Once all those features are not present, then it's going to be much more difficult. So for example, if you're working on early years, we've often been approached to look at, could we bring social investment into early years? Often the outcomes you're looking at are very long-term outcomes. They might be influenced by a lot of different things. It's going to take an awfully long time for the investors to get repaid. It's going to be hard to judge that one program was effective, and you might be working with quite a disparate group of people because you don't know, which of the children are the ones that you really need to focus on at that point. So there might be some ways around that, but just as an example, it's more challenging to define your social impact bond program for that sort of a challenge, that sort of issue.
Social finance's first big achievement was the development and execution of the world's first social impact bond. And it was in a program that involving the Peterborough prison inmates. What was the problem being solved at that point, and what was the need that led to the development of this social impact bond?
No, 100%. I think it's a great example of all those features that I mentioned. So you have, a well-defined population, which is people who are in prison for short sentences. So I think typically under a year or so. The problem is that those people coming out get very, very little support. Famously, walk out of prison with pounds in their pocket and very little else. And the reoffending rate for that group of people is extremely high. So the system as it is doesn't work for anyone. For the people concerned, they're getting no support to get back on their feet. For the system, they've just spent an awful lot of money on the police, the criminal justice process, and the prison time. And then in a very short time, they're almost certainly about to spend a whole lot more money on police, criminal justice, and prison time. So as well as the fact that for society, that person has now committed another crime, which is not great for society either. So that's not a good picture. But government also, I think, is quite sort of skeptical about, are there really programs that we could put in place that are cost effective, that we can really demonstrate actually reduce the reoffending rates of that group of people? And so the idea for the Peterborough Social Impact Bond was, if you can provide really high quality support for people coming out of prison from those short-term sentences and demonstrate that actually leads to reduced reoffending, then not only is that great for the individuals concerned, great for society, less reoffending, but actually might net save money. And the way to overcome the government skepticism was to say, actually, we'll find investors who'll put the money in up front, and government only has to pay if the reoffending outcomes are actually achieved.
So the government repays if certain criteria are met.
Exactly.
So I guess the question is, why can you achieve results that the government can't?
There's two things there. I mean, one is that government is constantly presented with business cases saying, if only you spend, when I was a councillor, I spent 5 years as the finance lead on the council. So we had a, £165 million discretionary budget, but under huge pressure from the need that we needed to address. And constantly presented with business cases saying, if only you spend £1 on this, we'll just save you £10 at the other end. The challenge the government and the Treasury faces is that, you spend the pound and then sort of the people who wrote the business case are long gone. And suddenly, the savings don't quite materialize. And so one thing was to be able to say to government, look, there's a structural underinvestment in these kind of preventative and community services, because government finds it very hard to really gain confidence that the programs will actually deliver. Can we bring in investors who will put their money on the line to build that confidence and enable government to say, yeah, you know what, we'll effectively outsource the risk here. If it doesn't deliver, we won't have paid. If it does, fantastic. We'll have got the benefits that we wanted and we'll pay. So that's kind of one element, which is the sort of structural, the upfront bit of getting government to invest in these services. But I think there is a second element, which is that, because of this policy implementation gap, government finds it hard. They spend a lot of time designing policy. And then when it gets into implementation, it's really hard to keep focusing the same level of focus when programs are being delivered for, years, when there's also other political priorities that emerge in the meantime. It's a structural challenge with government. And again, this is almost, saying, can we find a mechanism that enables structurally more focus on the implementation? And so you've now, asked investors to put their skin in the game and to make sure that they will keep that focus through the program delivery on actually delivering the outcomes. And if the outcomes are not being achieved, we're going to do something about it. Not, years later when there's an evaluation and says it didn't work, but actually during the program delivery, because we're seeing that data come through live. And, although social finance itself is not an investor, one of the things I've always been most proud of about social finance is that, yes, we're involved in all the design work and the business cases and the evidence gathering, but we stick with programs through implementation. And that's such an important discipline to really make sure the outcomes are coming through in the end.
You're floating a bond and you have private investors investing in the bond to fund a third party service provider, perhaps. And investors get repaid if the third party performs according to pre-established benchmarks. Am I right so far?
You got it.
But social finance is what, the arranger, or are you a fund, or do you have a fund that you raise and then you're like the general partner managing the service providers, or what?
Yeah, so we've played a mix of roles, because I think, in an emerging sector, you almost need to dive in and play whatever role you need to. I would say the one thing, that's sort of not helpful about the name social impact bond is that it doesn't really operate like a bond. It operates more like project finance. So effectively, we're designing a project saying, right, this is the kind of intervention that we want to put, the kind of program we want to put in place. Who are the partners who could deliver it? Which government departments will ultimately fund it on the basis of the outcomes achieved? What are the metrics that we're going to use? What's the evidence for how much money it's going to cost to deliver what kind of outcomes? So we do all that some design work. And then you work out your financial model and work out how much capital is required to fund the program up to the point where outcomes are achieved and payments are released by government. And then you go and raise your capital, your project finance effectively to fund the vehicle, which is to be a special purpose vehicle for that period of time. So that was kind of the original social impact bonds, really sort of project finance vehicles. We have managed a couple of funds. We have a slightly different model now. And that also has evolved over time, where, yes, essentially, instead of just doing it around one project, raise a pool of capital and then look at, multiple opportunities, which could, in some cases, be direct enterprise investments, so more traditional, or could be these kind of social impact bond investments where the return is contingent on social outcomes.
Sorry to bring up money, but this is an investment podcast. How do you get paid? Do you get a fee for arranging this? And is that benchmark based as well?
Yeah, so I think, again, in some cases, it's been the investor who's funded either, again, the initial stages or on a what we call performance management type basis. So we also will then stick with the project to work with make sure the data's been collected, run the financials, provide support through the program and so on. An investor might pay for that as well. Most of our funding now comes from doing projects and programs, usually with government partners or large international multilateral organizations. So it operates more on a kind of consultancy type basis, running projects. But in the cases where we still do work on investments, then the investor will cover our costs.
Okay, so in the case of the Peterborough One Service social impact bond, how much was raised? What was the structure? And what was the result? Because I imagine this has come out of the wash now, right? We've got some history and you've been able to measure things.
So we raised £5 million from a mixture of, in that case, trusts and foundations. So those were organizations which were largely philanthropic, but who were really keen to try out social investment. The program started in 2010. The actual intervention ran for 2 years, which are 2 cycles of people coming out of prison. And we then measured reoffending rates over a period of time after the program ended and compared that to what's called a matched cohort. So essentially looking at similar groups of people who were coming out of different prisons around the country on similar types of sentences, similar demographics and so on. And we found in the end there was a reduction in reoffending of just over 8%, which triggered a return to the investors, a small return to investors, I should say. And that was exciting because, in the evidence base around reoffending programs to reduce reoffending, I should say, there isn't actually a huge amount of success stories. So the fact that based on a pretty rigorous calculation of reoffending rates versus the matched cohort, the program was found to have reduced it by a significant amount.
Now, what were you funding? I mean, what was the service?
Oh, it was the intervention. So the intervention was a consortium program. St. Giles Trust played a big role in that, with some other organizations as well. And it was effectively, people would come out of prison and we would provide them with a bespoke individualized service. So, it was tackling whatever issue was the biggest blocker for them to, going back and living a normal life and having a house and a job and so on, which were often mental health problems for sure, often related to employment, sometimes drug and alcohol, often drug and alcohol problems. So a whole mix of issues. Provide, personalized support around that, some signposting to other services as well. And, just helping them get back on their feet.
And so the government repaid the £5 million investment. And then there was a return on top of that, which you indicated was rather low, single digits, I suppose.
Exactly. Yeah.
That was your first project. Your next big project was a social investment funded program running a large scale pilot program in the West Midlands. Tell me about that one.
When I joined social finance, the dossier that I was handed my first few weeks was looking at, which was a very lucky dossier. I'm, incredibly grateful for having the chance to work on this over the last few years for many reasons. But it was looking at this issue of people who are out of work with a health barrier. So typically people who are out of work for a long time have some kind of health issue. And the biggest challenge is often mental health issues. And even, when we were looking at nearly 10 years ago, there were over 2 million people who were in this category. So out of work, working age people, but not in work because of a health issue, 50% of which plus was related to mental health. And the reason I say I was fortunate to look at this was a couple of things. One is we saw very early on that there was a model of support, of employment support, that in multiple academic studies had shown huge promise. Success rates that were twice as good as the alternative interventions. So, and yet this model had not expanded widely in the UK. There were some sort of test sites. There was some government endorsement through NICE, for example, as a quality standards agency, but they hadn't had widespread adoption. So, it's a real gift that we got this significant social challenge causing not only huge problems for the people who are out of work, but also a significant cost to the government, around over £50 billion a year, an intervention that had really been demonstrated to work. So we started by creating a social impact bond, which is called the Mental Health and Employment Partnership Program, or MHEP. That model we started in 3 areas in 2016. And the idea was sort of twofold. One was, can we test how this evidence-based model operates and delivers under different kinds of contractual and financial conditions? Up to the time, you'd seen these academic results and you'd seen some pilots. But what happens when you apply the outcomes-based funding and external investment? Suddenly, you're going to have a different level of scrutiny on the outcomes being achieved. So the one was, do the results stand up on that basis? And the second was that one of our beliefs about why that model hasn't scaled or had not scaled is that it was funded by local authorities or some NHS organizations locally. But the big money for employment comes from DWP in the UK, the Social Security Department, which funds big national programs. And we hadn't yet seen DWP find ways of funding this type of model. So we thought, okay, could we use this as a test case to see if we can combine some of the local funding, which is really important because it creates that connection to the health system, with some national funding that could help to scale the model. And we brought all those different types of money together in this project finance vehicle. We raised investment from Big Issue Invest, and we started deploying in 3 areas in 2016. And we had opportunities to continue to expand that model to up to 14 areas by around 2019-20. And it's currently now, the project's coming to an end to the other side. And during that time, over 2,000 people with severe mental illness, learning disabilities, or drug and alcohol conditions have been supported to find paid and fulfilling work. So it was a really exciting model to be part of in the early days. But then it was also a really interesting case study of how social finance takes a social impact bond program, which has got some early and interesting and exciting results, and thinks about, well, how do you now use that to help change how a system works, not just, continue to fund specific projects in specific places.
To get this in my mind, the investors are like limited partners, and then there's the people that you're investing in.
Yeah, I think we generally call ourselves the intermediary, sort of broker, bringing the pieces together. Yeah.
So you're actively involved with the service provider, whereas the investors are not.
Yes, we certainly. They the role that we've played is to help find the service providers, working with the local authorities, councils, NHS trusts that are involved. And then as the investment runs, we will have a direct relationship with the service providers. Exactly.
Is there a typical maturity you would expect a bond to go out for?
I think we find that, almost the longer the better, in terms of really allowing programs to mature, to learn, to get results. When we started this mental health employment partnership program, it was originally a 3-year program, but we were able to continue to extend it through various means, raising more money, raising more capital, raising more outcomes funding. And, as I say, that will now have lasted. It will, if it broadly comes to an end this year, it will have lasted around 8.5 years. So that's probably one of the longer ones.
So they're typically, if you had to pick on
3, I would say 3-ish years. Yeah.
Okay. People want to see it out of works, I suppose.
Yeah. And typically it's hard to secure actually the outcomes funding from government for longer periods of time. So they don't want to lock up their money for budgetary reasons as well as anything else.
Is there an expected rate of return that one would expect from a social impact bond?
Again, I think it is hard to, it's hard to pin down. I think in the end, we are talking about, social investors putting their capital at risk and, looking for, broadly speaking, sort of high single digits, I would say.
Is there a default rate, meaning that you don't get the funding back because results haven't been achieved?
I think this is where the challenge of, thinking about it as almost an asset class is that because it's project finance, each program, and this is one of the challenges of it as well, ends up being relatively bespoke. So it's quite hard to think about it as a kind of asset class with these benchmarks. But there have absolutely been programs that haven't returned all of their capital. That's definitely been the case in several programs, and others which have been either exceeded returns, lower returns, and so on. I guess the thing that the class of model that we haven't talked about, which is now what we're most excited about at Social Finance, is the model where the investor is a charity or foundation where they are investing instead of making grants. And so if you think about it, they're moving from a kind of minus 100% return into a 90% return or 0% return. Probably not a positive return, actually. They're not really looking for a financial return. But what they are looking for is a way of making their grant money go further and for their grant money to generate more sustainable change.
So it's kind of blended finance. Do they take the first losses and then the private investors are second in line?
Yeah, I think there are there's other territory where blended finance is definitely something that we're really interested in. I think in these cases, and just to make it explicit, we've been working with Macmillan, the cancer charity, for the last few years, looking at using their funding to invest in end-of-life care services and now, thinking about wider types of health services. And, in that case, as I say, there's no co-investor in the current model. They're doing it all themselves, and we are supporting them, and they are just, looking for as much capital return as they can get without having any positive return on that.
How do you develop deal flow? Because I guess that's your job. You put the projects together. Where does your deal flow come from?
I think in the early days of social impact bonds, we had a lot of central government impetus around it. I mentioned that David Cameron was a big champion, Jeremy Hayward was the cabinet secretary, Ian Duncan Smith, and so on. And so, for example, there was a point where, DWP issued around 10 social impact bonds. And they said explicitly, we want 10 social impact bonds, focused on supporting young people at risk of becoming not in education, employment, or training. Similarly, you had another government department issuing a whole tranche around rough sleeping, for example. So there was a kind of wave where people were saying, well, we can issue a bunch of these. I think we haven't had that from central government in a number of years, since about 2016, really. And since then, the focus has been, okay, well, where can we generate interest from local systems? So local authorities typically, or combined authorities, or, NHS organizations, NHS systems, where, this could be an attractive model. And that's why we have found the Macmillan partnership so powerful, is that we're able to go out proactively to NHS organizations nationally and say, look, we have some really sympathetic capital here that not only just comes as finance, but also comes with, support from ourselves, Macmillan, tools to better measure outcomes, the data, the operational support, the network to the other projects that we're working on, and put together a real offer of which finance is a really important and leading part. And then NHS systems have responded to that, and we start to work with the ones who are most excited by that model. And then there's a process of, working through with them. Okay, how's that exactly going to work? Do you have, budget that you can pay back if the outcomes are achieved? What are the needs of your system? So starting to develop then on a bespoke, case by case basis to make the model work in each area.
Could you give me one real world example of something relatively recent? Where did the idea come from, and then how you went out and got the project structured, and then how you got it funded and executed?
Yeah, I think a good example in this portfolio of investments in services to support people at end of life, there was an area in West London, Hillingdon, that we started working with actually probably back 8-9 years ago, and talking to them about the needs of their system in end of life care services. And, what we found, which is the case in many areas, is that at end of life, most people actually say that they would like to die in their usual place of residence, usually at home. But the reality is that many people end up dying in hospital. And that's not good for the individual, their family and carers in terms of the experience they have at that critical time of life, but also it's not the right outcome for the system either. And we've been working with a model that was pioneered by Marie Curie, where essentially you have a point of access, point of contact for people at that stage of life who can get help when they need it. And if needed, actually get access to a rapid response nursing service. So the nurse will come around to the house pretty quickly. And that builds a lot of confidence that people don't actually need to just call the ambulance and go straight into hospital. So we invested in that single point of contact, in developing single point of contact and rapid response nursing service in Hillingdon. And that's been a really important project. And I think, supported over 2,000 patients in the community, of which 90% are able to die in their usual place of residence. And I think also, to the point about sustainability, that service has been sustained since when the social investment came to an end in 2021. So another example of where it really helped make the case for that system to say, yeah, this is something that we should be part of our provision.
And who were the investors that came into that?
That was done through what we call the Care and Wellbeing Fund, which was a co-investment fund between Big Society Capital and Macmillan.
Are the impacts always easy to assess, or are they difficult to assess due to poor benchmarking data, or maybe the absence of data sharing platforms and so forth?
Yeah, I would say never easy is the short answer to that one. I mean, I think you've got challenges at multiple levels. The first challenge is, can you define a a measurable outcome that we can all agree on and that we can measure quite precisely? So, when I was working on the mental health and employment program, we thought, well, that's quite easy because all you need to measure is, do people get a job? And of course, it's not that easy at all because, what do you count as a job? Is it 1 day in work? Is it 8 hours, 4 hours, part-time work? Or do they have to sustain their job for maybe 6 weeks? Or in the European programs often work with 3 months. Or do you look at longest periods of sustainment, 6 months, 12 months? What if they got a different, had 2 jobs? What if they got a job and then left and then got another job and so anyway, and these were, I slightly jest, but actually these were legitimately the conversations we were having with providers about, do you count this outcome or not, or that outcome, and trying to be authentic to, what you're actually trying to achieve in the end, which is, a better life for the individual, the system benefiting in terms of reduced welfare spend and so on. So it's really important, can you all agree on something which at least is not going to be perfect, but at least it gets you sort of most of the way there. And by the way, if you can't, then maybe social investment is not the right model. And actually, there are some different things we should be thinking about. Maybe we need to start earlier in the process around what is the right kind of data architecture and how do you bring in different, ways of measuring outcomes and so on. But that's a whole sort of different topic. Assuming you can actually agree on an outcome, then I think you've got to be really, proportionate about what data you're going to collect, because especially for small scale social programs, data collection is really expensive and burdensome. And, you often get into a situation where the program that you're actually funding is about an individual, a caseworker sitting with their client, trying to support them to achieve an outcome. And you want that interaction to be a really important moment where the magic happens and where, you can make progress. And the risk is that you spend 90% of the time asking the person to fill in forms because there's all this data to collect. And there's a huge gap, I think, between the government, funders, the investors, often us, who are saying, well, it doesn't sound very burdensome. And the providers are saying, well, actually, collecting this data is causing an enormous amount of challenge. So I think you really got to think about being proportionate. And one of the things that I think we think quite hard about is the data, of course, has to be ultimately useful to the funder and to the investor. And, the reason you collect the data is not least to make the case that, to trigger the outcome payments, but also make the case that actually the thing is working and to be able to make adjustments if it's not working. But I think it works really well when that data is also useful for the delivery team themselves, maybe the service leadership and so on, but actually even better because the frontline staff can get some value from that data. And again, if I use the example of the employment model, what we did there is, we've been thinking a lot about, now that we've moved beyond the social impact bond and we've been working on providing support to the sector as it grows, we've been thinking about, okay, how do we, support services all around the country to collect the quality of data that we were able to collect when we were doing it at small scale, with investors sitting over the model and all of that. And we built a reporting tool which essentially allows people to take the spreadsheets that they collect routinely in their interactions with customers and just, upload them and get very quick access to the outcomes, to simple dashboards about the outcomes they've achieved, instead of trying to, go line by line and add up the number of jobs and all that sort of stuff. So that was supposed to just make, the idea of that is that it just makes it a lot easier for the providers themselves to get value from the data they're collecting for the funder. But, the tool was the sort of fancy bit. Actually, one of the big pieces of value in the process to get there was simply looking around the sector and saying, what are all the data points that people are collecting? There's hundreds of them. And can we standardize in a simple set? Okay, you might need to collect all kinds of data points for your own reasons, but just collect these 10. And if everybody just collects these 10, then we can get some really crisp outcomes data. And we can also start doing all those things that you talked about around benchmarks, understanding performance, and all the rest of it. And I think that's quite a big piece of that puzzle.
Maybe you could just describe to me at the 30,000 foot level, what's your current role and how do you describe what you do? And then we'll move into Columbia Threadneedle.
Originally, I was managing about 8 billion of pension funds, life funds, annuity funds. I've been managing corporate bonds, as I say, for 30 years. But if we go back to 9 years ago when I met Big Issue, I was launching the fund at the same time as being on the investment grade desk and doing all those things as well. And it became fairly clear around about 5 years ago that this was something that I wanted to do. And we were in the throes of thinking, can we extend this to other products? Can we do a European version of the fund, et cetera, et cetera? And so at that point, 5 years ago, I moved away from the investment grade desk and then went to sit physically with the responsible investment team. We were a growing team at the time, but again, it was 3 people. I always seem to end up with teams of 3 people that, in addition to me, that is, went to sit on the responsible investment desk. And now this is a team of, I don't know how many we've got, 16, is it? I think 18. I can't remember exactly how many responsible investment people there are now. But I went to sit with them and we backfilled my role so I could pass on the life funds, pension funds, annuity funds. I always said temporarily, because I always thought actually that these types of funds, these institutional mandates, they would catch me back up. Yeah, I would not be leaving them behind forever. And in fact, I was managing Zurich's money and they very much are catching you back up, so that these kinds of concepts, I was just a little bit ahead of the game. And so I went to sit on the responsible investment desk. The launch of the fund some 7.5 years ago was the start of it. We adopted a social partner. The social partner's role was to, one, define the 8 areas of social outcome that we are targeting. What is social was a question for the social partner, the experts. Big issue defined those 8 areas of social outcome. We established an oversight committee called the Social Advisory Committee, which, if you like, replicated what you would see from a risk committee on the financial side. There's always a financial side. There always ought to be an equivalent for the social side. So if you've got a risk committee for holding your feet to the fire on the financial side, you should have something equivalent. And that's the Social Advisory Committee, which is the second point. The social partner touches the process because 3 appointees come from the social partner, from that Social Advisory Committee. One is an independent, which is John Hale, who used to be the bond guy at the Association of British Insurers and used to run the special committees and used to facilitate the restructurings and the dealings with bondholders, now retired. He's our independent appointee and indeed chairman. And only 2 from Columbia Threadneedle, 2 appointees from the fund manager, myself and Ian Richards, the head of responsible investment research. So we're outnumbered, and quite rightly so, and we're outvoted, and quite rightly so. And that provides an oversight on the promises that we make to investors on delivering the social credentials of the fund in the same way that the risk committee would do on the financial side. And the third area that they touch the process is once a year. And actually, we're approaching the mid-year point at which we take a snapshot of the fund, and then they will produce an impact report on the fund, which I'm sure can send you a copy of the last one. So those are the 3 points at which big issue touch the process. But key to it actually is the quarterly meeting of the Social Advisory Committee. And the purpose of that committee is to review, advise and challenge everything that we do. But actually the social analysis, the analysis of the social intensity, the way that we go into the evidence-based approach, that's very much within the remit of Columbia Threadneedle. It's our fund. We managed to find it's not run by committee. And so this is an after the event kind of thing. Apart from the concepts of advice, I don't want to go to that committee with a problem. If there's any contention about is this social or isn't it social, I have the ability intra-meeting to go and say, what do we think? Does it conform to one of these 8 areas of social outcome? Is it social enough? Is it net benefit enough to society to qualify as an investment for the fund? So I can lean, and I do lean on them where there is normally contention as to whether it's social or whether it's not. That tends to be right on the edge, those kinds of credits there. The philosophy that we actually have for the fund is very much based on this idea that we're coming to it as an idea of a bond market expert's way of delivering for society through the asset class that he knows. So when I described how we would go about it, it's a big issue. I didn't know that this was called impact. I didn't know the concepts of ESG. I didn't know sustainability and ethical and all these acronyms and different ways of describing things. I just knew how my asset class could best deliver for society. Now, obviously, subsequently, I've discovered that this is, in fact, an impact fund. And actually, we are going about this in a different way to pretty much everybody else out there. And the reason is because I'm using the bond market to the best of my ability with my experience in order to try and deliver in the best way. That's why it's not an RI overlay or an ESG overlay. So what we have is basically a positive inclusion philosophy, not a negative exclusion philosophy. So don't exclude a few things and then just carry on as normal. But we do have minimum standards. So we do avoid alcohol, tobacco, things like that. But we do recognize that actually, in the case of alcohol, there's actually no problem with the product. The product is absolutely fine, and in moderation can be quite beneficial in health terms. The problem is the abuse of the product, which creates tremendous problems for society. And so when somebody like Carlsberg has an aspiration to not only have ESG credentials, but actually to have a zero effect of their product on society, we're very interested and we engage and we go and find out what they mean by that, because that could be the solution. The effect of the product on society being the problem. As it turns out, all they're actually doing is providing a non-alcoholic alternative wherever they're selling an alcoholic product, which doesn't actually solve the problems of the abuse of the product to society. But nevertheless, we would engage. We'll even engage with the tobacco industry in terms of heat not burn and vaping and those sorts of things. Not that we'll invest, but we will investigate. So it's not excluding whole sectors of the economy and saying, I'm not going to go there, I'm not going to engage there, I'm not going to even investigate. So positive inclusion is very much a mindset and a philosophy. We then move on to an evidence-based analytical approach. It's very difficult, or so people tell me, to measure social, because they want to find a one-size-fits-all carbon footprint, carbon emissions, carbon transition, whatever the equivalent is. They want a one-size-fits-all equivalent of the carbon element, the environmental element, the E to the S. Actually, there are lots of measures that are relevant and appropriate, and we will take any measure from wherever we can find it as long as it's appropriate, and we'll build it into our process as evidence. So we have an evidence-based approach. And necessarily the evidence for an educational outcome is going to be different to a health outcome. But that doesn't mean that you can't build those evidence pieces into a very similar and structured formula for following the analytical approach through to the outcome that we can then deliver what we call a social intensity score. But what we are actually looking to do sometimes is we can't find the evidence that we want, the sorts of things that we're looking for. We have to engage. And engagement is the third. We engage with companies, we ask the awkward questions that they're not expecting. They might be expecting us to ask what director's remuneration is all about, or the vice chancellor's remuneration for a university. They don't tend to be expecting the questions that we usually ask is, in terms of your employment credentials, how are you treating your catering staff, your cleaning staff, your maintenance staff, the vulnerable employees? Those are the ones that we're focusing on. How have you treated them during furlough? Have you topped up furlough from 80% to 100%? Have you laid off staff? Are you paying a living wage? Are you training? Those sorts of criteria. So we're asking those kind of questions because that's part of the analytical process to try and find out those sorts of answers. So the three real pillars are positive inclusion, evidence-based approach, and the real engagement element. But the key thing with the bond market, you're a stakeholder. You're not an owner. So your ability to access management is greatest when they want something. And what do they tend to want? They tend to want money. So actually your access to management is normally best at the same time as your opportunity to achieve impact, i.e. through the new issue process. Because they want to sell their new issue, they'll engage with you, they'll answer your questions. And sometimes they say to me, why do I need to go to the time, the effort, the cost of providing all this information you want? And we will say to them, because we will score you on the quality and clarity of the evidence you provide. And if you get a better score, I'll buy more of your bonds. And if I buy more of your bonds at the margin, I'll lower your cost of capital. So it's an incentive-based approach, even down to the kind of impact statistics that we're looking for. But that's the point at which the new issue comes in. So we're really focused quite heavily in terms of impact on going for the new issue market. But we are a daily price, daily liquid fund. And so, of course, we buy secondary issues, but we talk more in terms of them being outcomes. So we talk about an outcomes-based approach, but we have an impact report and we're focused on achieving impact within the remit of the fund. So that's the philosophy behind it.
These are all investment grade bonds that you're going to.
These are predominantly investment grade. So we can buy up to 10% of high yield. This is a typical investment grade corporate bond fund with an average single A rating. But, in any typical investment grade corporate bond fund, there is a small proportion of high yield that you can buy and contingent capital and those sorts of things. And the key thing about it is that we're focused in the UK social bond fund 80% of the outcome, 80% of the impact needs to be domestically focused within the UK.
Right.
So we're focused on, let's say, Iberdrola, who issue a green bond. Iberdrola is clearly a Spanish company, Spanish domicile, Spanish head office. The use of proceeds of one of our green bonds is 100% to fund wind farms off the coast of Norfolk in England. So the domicile might be Spain, the impact is the UK. So 80% of the impact needs to be domestically focused in the UK. And when we move on to the European Social Bond Fund, 80% of the impact needs to be within geographical Europe. We say geographical Europe because one political Europe in terms of Brexit is a little bit contentious, but it's because we're looking at the society of Europe. And that's not necessarily best defined by the politics of Europe. It's best defined by the people of Europe. And that is not changed by Brexit. You can't exclude Switzerland and Norway because they're not part of the EU. It's geographical Europe, the society of Europe that we want to benefit there. So those are the kind of the focus points, if you like.
So you started the UK Social Bond Fund, right?
Yeah.
It was my idea.
And you have this European Social Bond Fund, but then you also are responsible for Columbia Threadneedle's RI, responsible investment strategies across other asset classes. Columbia Threadneedle is huge. And where do you fit in the big picture?
I run 3 funds. I run the UK Social Bond Fund, launched in December 13, the European Social Bond Fund, April 2017, and in September 18, an Austrian pension fund that was invested in the UK Social Bond Fund said, I'm going to take the money out and I want to put it into a segregated mandate and I want you to go global. Do exactly what you're doing, but I want you to do it globally. So we now have a global segregated social bond fund. The total assets under management of those 3 funds is about $1.1 billion across those 3 mandates. In between times, in the US, in 2015, they launched a US social bond fund. So a year after they launched the UK social bond fund. But what, again, we're looking for is the effect. Mm-hmm. So how we do it is different. The effect should be the same. And you've got the great advantage of having the municipal bond market in the States. So if you want to fund schools and hospitals and those kind of things, you've got a municipal bond market to do it. So the US Social Bond Fund is focusing on the same kind of outcomes, but it's using the muni bond market, and indeed it's tax advantage on the basis of, for US investors at least, it's tax advantage. So it's a different way of doing it, but the aims are still the same, the benefits to society, etc. So that is around about, I think the last I looked was about $66 million. So the bulk of the AUM is in the 3 mandates that I run. Still the largest one is the UK Social Bond Fund, although the European Social Bond Fund is catching it up rapidly, depending on which currency you turn it into, but at least in terms of a dollar equivalent, it's catching it up rapidly. And I chair a meeting called the RI Construction Meeting each month. My job title is the Director of Responsible Investment Portfolio Management. So I'm responsible for portfolio management in responsible investment. So there is a separate research function, and obviously there are elements of the distribution and marketing side which are different. But in terms of portfolio construction, portfolio management, those kinds of things, what we're trying to do within that meeting and what I'm trying to do within my role is effectively challenge between the different asset classes and the different fund managers, idea generation between the different managers and asset classes, and sharing best practice. Those are the three elements of that particular meeting that we're trying to do. So we are involving our infrastructure team, we're involving our risks team, our 5P team, and indeed the other managers of what we are now calling Category 8 and 9 funds, or in our own internal model 3 and 4. These are the most impactful or the most sustainable outcomes focused fund managers that will all get together and have a construction meeting amongst ourselves so that we can really hone down on the ideas of, if you like, the GIM group in the equity fund and pure GIM in the high yield fund. These are ideas that are very similar with, different companies, but it's effectively how can exercise and gyms, etc., and particularly that kind of pay-as-you-go gym concept, that lower costs, not paying anything up front, how can that benefit the health of the nation and therefore contribute towards society? It's the same idea in the equity market through the GIM group is through the high yield market. And actually that's one of my high yield holdings in the investment grade fund. This idea generation and sharing of best practice and challenging of ideas is very important in the fact that we're all facing the same kind of challenges, opportunities within our own different asset classes. So I translate all of that as well.
Threadneedle is involved in what might call classic SRI for the exclusionary type of practices for years before you launching the UK social bond fund.
We do build that into the way that we actually manage the impact funds, because when if you said to me, how do you go about the process of picking bonds, buying, assessing bonds, etc., first and foremost still has to be the financial criteria, because ultimately, if you get that wrong, if in extremis a company goes bust, you're neither going to deliver the financial return, nor are you going to deliver the impact. So it has to be the first consideration, which is the basic traditional financial rigor, the bottom-up fundamental stock picking that we're famous for, actually. You then move on to the second stage, which we describe as the ESG stage, which is effectively the internal management practices, what goes on within the four walls. We always talk about ESG as being doing the thing right, and impact as being doing the right thing. And if you do quote me on that, we've stolen that. I admit it fully. We stole that from PGGM, the big Dutch pension funds. We're looking at the internal practices. What are their environmental credentials, their employment credentials, their governance? How do they go about managing their business within their own four walls, etc.? That's the ESG stage, but we have a particular emphasis on controversies. So it's not necessarily the incidence of controversy that we're looking at. It's management's reaction to those controversies. Do they mitigate? Do they compensate? Do they make sure it's not going to happen again? And that, we feel, gives us a window into the culture of management. Because under pressure, how do they behave? Do they do the thing right? And if they do, then that gives us confidence that they're going to do the thing right going forward. And it's a cultural assessment, if you like. If they don't do the thing, we don't go any further, because we have got several instances where we don't like what we're seeing, we don't like the answers we're getting, etc. And so the ES stage is a fail rather than a pass. But that is, if you like, fairly traditional, but with an emphasis on controversies because of that more forward-looking cultural assessment that we can ascertain from that. And that's very much based on engagement. If there's a controversy, the first thing we do is engage. We don't just deal on press speculation, knee-jerk reactions, etc. We want to find the details, the evidence, how it affects particularly society, etc. So that's the second stage. And only if we've passed those first two stages will we then go on to the third stage, at which point we drop from the company level assessment down to the bond by bond assessment, which is the impact stage. And that is where we are looking principally at the use of proceeds through the bond market and the good that use of proceeds is likely to do for society through the bonds that we're buying. And sometimes, I say bond by bond assessment. If I give you an example of NatWest issued 2 social bonds, ICMA branded social bonds, use of proceeds specific towards, in the first instance, SME lending in deprived areas of the UK. So addressing deprivation, additional lending, the kind of elements that we're looking for are, is there additionality, additional services, additional infrastructure, etc.? Is it tackling a deprived community within society? Might be the young, might be the old, it might be the disabled, it might be displaced persons or refugees, it might be areas of deprivation geographically within the country, as is the focus of the NatWest social bond. But the second social bond they issued was doing something completely different. That was funding lending to affordable and social housing providers. So actually, same issuer, same structure, they're both social bonds, completely different outcomes. You have to do a bond by bond assessment, which is real heavy lifting for the poor old social analysts that we've got. But those are the 3 stages that we go through. And even then, I've got to look at the portfolio and say, this additional bond that you just analysed, that's past the financial, that's past the ESG and controversy, and actually we've determined the social intensity, it still might not fit in the portfolio because it might not be a good fit. It might be not what I'm looking for. I might have something better already, etc. So it's a way of filtering down a large number of bonds into more likely ones that are going to do good for the portfolio. But the real heavy lifting, the real hard work, granular assessment occurs with the impact, the responsible investment analysts' impact assessment.
Are all of these use of proceeds ring-fenced in all the bonds that you invest in?
No, that's the difference between the fund that I'm running and, let's say, Amundi, who runs the Global Social Bond Fund, where I believe, you'd have to check this up, but I believe that they will only buy ICMA branded social bonds. This is not an ICMA compliant social bond fund. This is a bond fund that is aiming to do good for society. So we will buy general corporate purpose bonds. We will buy green bonds with social benefits. Let me give you an example. Transport for London issued a green bond and it had its environmental credentials and we engaged with them. I said, actually, you're regulated to be green. You have to be green. It's not really adding anything. There's no additionality here through issuing a green bond. Where the additionality occurs is the fact that I know that the use of proceeds is towards, at the time, it was to build the cycle superhighway in London. It was to buy more Route Master buses. It was to upgrade ticketing offices and generally upgrading the cheer network, i.e. additional infrastructure in a crowded, populated, polluted, at the time, capital city, which was very much beneficial to society in terms of the provision of transport infrastructure. And I said, your additionality, your additional benefit through this bond is social. Came back to me and they actually gave me a whole load of evidence to that effect. And then said, but we're still going to issue a green bond because we know there's demand for green bonds and we want to issue a green bond and we want to be showing that we're green. But actually, that's a really social green bond. You might say to me, what's a green bond that's not social then? Actually, Unilever issued a green bond that was basically use of proceeds to make more efficient ice cream cabinets for their ice cream. Now, I'm sure that's good for the environment. We want more efficient ice cream cabinets, lower energy, etc. Is it addressing a deprived community within society? Is it really satisfying a need for society? I wouldn't say that ice cream is an absolute essential, is it really? So we would regard something like that as being, yes, it's a green bond, it's beneficial environmentally, but it's not a green bond with social benefits. So that's the way that we look at things. We don't actually care the structure of the bond over and above the fact that actually it's helpful that we know the use of proceeds with the green bond because it is ring-fenced use of proceeds. And actually with the campaign that we launched in May 2019 for the Green Gilt, which I spent an awful lot of time, particularly in the back end of last year with the Grantham Institute, the Green Finance Institute and the Impact Investing Institute on their working party. One of the concepts there was the fact that we called it initially when we presented it to the government, the Green Plus Gilt. That referred to the fact that we wanted, yes, environmental projects, yes, building back better, green jobs, all those kinds of things. But actually we wanted the reporting to reflect not just the environmental credentials, but the social co-benefits. We've now managed to embed that within the new latest published Green Bond Principles. So the Green Bond Principles now recommend that in terms of reporting, you also report the social co-benefits even of a green bond. So that kind of concept that we started with the Green Gilt, we've now built into our work we do in subcommittees in IFVI for the Green Bond and particularly the social bond principles. So we will take any bond of any description, if we can identify the good that it does for society and analyze that and use the evidence that we find to prove that, then we will buy that bond.
You've mentioned the big issue a lot. You mentioned earlier that they walked in the door and I think you somehow partnered with them. Why was it important for you to partner with them? I just want to get that clear in my head.
Yeah, we believe in the partnership model. At the end of the day, Columbia Thread and Eagle are well known for their financial acumen. We're well known as, Minneapolis, Boston, London, our financial credentials go before us. We're not known for, and we wouldn't claim to be experts necessarily in social. So if you're launching a social bond fund, we believe in the partnership model because what Big Issue bring above those three areas they touch the process that I've already taken you through, they also bring their expertise and their reputation to the product. We've got a history of a partnership model. So we've got a low carbon workplace fund where we partner with the Carbon Trust. In the European Social Bond Fund, we've got a different social partner, but nonetheless, we've got a more pan-European social partner. We've also brought on board into the social advisory panel for the European fund, Oxfam, as a much more international perspective on things. So we're trying to bring in expertise, reputation, those kinds of things on the social side, because we recognize that we bring all the credentials on the financial side. We need something to mirror that. As I've said before, everything we do on the financial, we're trying to find an equal and equivalent process or resource that matches it on the social side. So that's really the idea. We believe in the partnership model because we want to recognize what we're good at and we want to recognize what they're good at. And if you're launching a social bond fund, it's absolutely essential that you have somebody that's good at the social and gives you good advice, and their reputation gives them real skin in the game.
Yeah. What is the work that they're doing that's important to you?
The three areas that they touch the process: setting the 8 areas of social outcome was them. Sitting on the social advisory committee regularly on a quarterly basis is where they probably interact with us most often. And indeed intra those meetings as well. If we have a problem, is it social, isn't it social, we can go to them. And the third area, and probably the most productive output of their expertise, is that they will produce, separate to us, independent to us, an independent impact report on the fund, which comes out based on the data on the 30th of June every year. And so that's public information. You can go and read that. I think it's a 68-page report for the UK Social Bond Fund. Have a look at that, because that's really where the impact of the fund comes to life. And they will shed a light on the fund and the portfolio, in addition to the way that we manage it in terms of the evidence-based analytical approach, the social intensity scores. They will look at it from different angles in different ways as well. So they'll look at the place-based investment angle, how much the portfolio is focused on areas outside of the Greater South East, the more deprived areas, etc. What are the jobs criteria? They use their own proprietary process called JAM. It's a job index based on the sectors that we invest in, jobs intensity, that kind of thing. So a lot of what they're doing is actually in that impact report, in terms of actually reporting on the fund and being an independent voice on the fund on behalf of, and to report to investors. I always talk about the impact report. It's my end of term report. It's like being back at school again. And the report doesn't go to my parents. The report goes to my investors.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.